The event unfolding tonight has the potential to fundamentally redraw the global financial map, beginning with a nation long viewed as an economic anchor in Southeast Asia. We're talking about Vietnam and its currency, the Dong or VND. This is not a drill, not a speculative rumor, but a genuine, powerful, and unprecedented overnight movement that has blindsided veteran traders, forced economists into immediate recalculations, and sent global investors scrambling to make sense of the sudden shift. This monumental surge in the Dong's valuation has generated palpable shockwaves that are reverberating not just across the Asian continent, but throughout major financial centers in Europe and the United States, positioning this event as a critical financial turning point for the coming year. We are here on Dinar Shift to dissect the complete narrative behind Vietnam's astonishing currency surge. We need to explore the underlying economic mechanisms that made this move possible, the strategic intentions behind the timing, and crucially, what this event signals for the broader world of emerging markets, especially for nations like Iraq and its currency, the dinar. The magnitude of this unexpected development cannot be overstated, and understanding the strategic blueprint Vietnam followed could provide the clearest roadmap yet for a potential next move involving the Iraqi dinar. Stay locked in, because the financial dynamics we are witnessing right now in Vietnam are far-reaching and hold profound implications for the global monetary system. The first signals emerged late last night across international currency tracking platforms, initially dismissed by many as mere technical anomalies. The Vietnamese Dong, long characterized by its relative stability around the 23,500 per US dollar level, began an unexpected and dramatic ascent. Within a remarkably short time, just a few hours, multiple independent and highly reliable market feeds started confirming the same unprecedented spike. This wasn't a minor fluctuation. The VND exchange rate soared, moving aggressively to a stronger position of 18,000, and on certain institutional trading screens, the quoted rate was reported as high as 15,000 or even 12,500 dong per single US dollar. This massive leap, the largest single night move for the dong in over a decade, has simultaneously generated excitement, confusion, and a heightened sense of curiosity across the entire financial community. The central mystery dominating global discussion is straightforward: why this powerful revaluation, and why at this exact moment in time? The answer requires a look behind the curtain at the sophisticated economic groundwork Vietnam has been laying, largely outside the immediate glare of the global media spotlight, for many months. The country has been experiencing a genuine and powerful economic upswing, fueled by a relentless surge in manufacturing, robust export figures, and substantial inflows of foreign direct investment that have consistently exceeded all previous forecasts. Global manufacturing giants have accelerated their production shift out of China and into Vietnam, significantly boosting the nation's industrial output and enhancing its international trade balance, fundamentally strengthening its economic foundations. Crucially, the Central Bank of Vietnam has been meticulously accumulating massive stores of foreign reserves. These reserves, representing a country's financial shield, provide the necessary liquidity and backing to strategically support and, if desired, strengthen the national currency amidst global economic volatility. This prudent build-up provided Vietnam with the decisive, necessary leverage to execute a currency-strengthening move at an opportune time. Whispers within knowledgeable financial circles have long suggested that Vietnam was systematically preparing the necessary infrastructure for a calculated and controlled revaluation. The dramatic events of last night are now being interpreted as the undeniable first manifestation of that long-term strategic plan being put into action. Further evidence suggesting this was a deliberate, controlled maneuver, rather than a random market event, is found in the meticulous timing of recent banking system updates. In the 24-hour period immediately preceding the currency spike, several of Vietnam's major commercial banks entered into planned, overnight maintenance windows. Such system updates are the exact moments when digital exchange rate tables, the critical data points used to update currency values across massive online and institutional networks, are typically adjusted. Significantly, similar back-end maintenance was simultaneously reported by major international banks in key financial hubs, including Singapore, Dubai, and even the United States. For market observers, this synchronized activity across multiple international banking systems is extremely unlikely to be a simple coincidence. Instead, it strongly suggests a coordinated technical preparation for a major, planned financial adjustment. When official currency rates change dramatically immediately following synchronized, large-scale system maintenance across the international banking network, it provides a powerful indicator. This points directly toward an intentional, strategically controlled revaluation, clearly separating the event from random market volatility or speculative trading activity. The precision of the timing underscores the calculated nature of the entire event. As the sun finally broke across the Asian continent, the financial world awoke, not just to confusion, but to a collective, intense curiosity about the magnitude of the shift. The powerful surge of the Vietnamese Dong immediately triggered a chain reaction across other regional markets. Stock exchanges in key Asian cities, including Tokyo, Singapore, and Seoul, reacted with sharp, immediate movements as institutional investors were forced to recalibrate their extensive portfolio positions. Global commodity prices also saw shifts, with gold futures inching upward and oil futures showing a slight but noticeable adjustment as the market digested the news. Across various social media platforms, a new, highly charged phrase began to trend: Vietnam went first. This viral trend highlights the consensus that this move is far more impactful than a localized event affecting only Vietnam's currency. It is being viewed as a significant signal sent across the entire spectrum of developing economies globally. The message is clear that undervalued currencies, backed by strong, underlying economic fundamentals, are finally beginning to adjust to reflect their true, intrinsic strength and value. For Vietnam itself, this revaluation brings immediate, tangible benefits. Imports become significantly cheaper, the purchasing power of its citizens sees a dramatic increase, and the country gains valuable new leverage in critical international trade negotiations. However, the ripple effect on the rest of the world is what commands the most attention, particularly for other nations with currencies that are widely perceived to be suppressed or undervalued, most notably Iraq. Analysts suggest that Vietnam's bold move could mark the beginning of a much broader, fundamental transformation of the global monetary hierarchy. Vietnam's economic ascension is not merely a matter of numbers on a screen, it is the culmination of a deliberate, long-term national economic strategy. For many years, the nation's economic policy has been laser-focused on fostering rock-solid stability, encouraging gradual yet robust growth, and proactively cultivating strong relationships with major international business partners, including Japan, South Korea, and the United States. Vietnam has carefully maintained its financial independence, ensuring it is not overly reliant on any single major currency bloc. By executing this strengthening of the dong, Vietnam is now sending an unmistakable signal to the world it is ready to elevate its status and stand shoulder to shoulder with the most powerful economies in the region. Financial experts are now widely predicting that this move could cement Vietnam's position as a top 5 economy in Asia before the current decade concludes. The timing of this strategic maneuver is considered impeccable, occurring at a moment when global trade routes are being rapidly reassessed and international supply chains are undergoing a massive reorganization in the post-pandemic era, with Vietnam positioned as a primary beneficiary. By significantly raising its currency's value, Vietnam is projecting an image of maturity and confidence, signaling its readiness to engage on the global stage as an equal partner, not simply a lower-cost follower. For the everyday person, the intricacies of currency revaluation can often sound like abstract financial jargon. However, the importance of this event cannot be overstated. When a country the size and significance of Vietnam adjusts its currency value so dramatically, the effects permeate every corner of the economy. Everything from the cost of imported goods and the profitability of exports to the patterns of consumer spending and the movement of international investment flows is subject to an immediate and significant shift. Companies that conduct business with Vietnam must now confront and adapt to entirely new cost structures. Investors who hold assets denominated in the Vietnamese Dong, such as government bonds or local real estate, stand to see potentially substantial returns based solely on the exchange rate shift. Furthermore, Neighboring countries within the ASEAN economic bloc, including major players like Indonesia, Malaysia, and Thailand, are now under immense pressure to formulate a strategic response. The logic is simple: if one major regional competitor strengthens its currency, others may be compelled to follow suit to maintain their economic competitive edge. This powerful, cascading ripple effect is the precise reason why financial analysts are now turning their attention toward the Iraqi dinar as the next potential candidate for a significant currency adjustment. The connection to Iraq is a direct one, holding significant implications for the dinar community worldwide. For a considerable time, both Vietnam and Iraq have occupied similar financial positions. Both possess massive underlying economic potential, yet their national currencies have remained demonstrably undervalued relative to their true economic strength. Paralleling Vietnam's preparations, the Central Bank of Iraq (CBI) has been diligently and quietly working to restructure its fundamental monetary policy, implement modern financial systems, and align its regulatory framework with established international standards. The preparatory steps taken by the CBI, system modernization, economic reforms, and alignment with global bodies, mirror precisely the actions Vietnam undertook in the run-up to this move. Both nations have operated under varying degrees of International Monetary Fund's (IMF) oversight, committing to major economic reforms designed to stabilize and modernize their economies in preparation for potential rate adjustments. With Vietnam now having successfully taken its first major strategic step, many analysts believe that Iraq is logically next in line for a similar realignment. The Vietnamese revaluation establishes a crucial working precedent, demonstrating convincingly that a controlled, stable, and strategically planned currency strengthening is not only feasible but is also compatible with international financial institutions' approval, including the IMF. For many in the dinar community, this event is being heralded as the definitive green light moment, validating years of anticipation regarding a global monetary shift. To clarify the terminology, a controlled revaluation is the deliberate strategic action taken by a government or central bank to raise the formal value of its currency. This is executed with careful planning and coordination, often with the tacit approval of international partners. It is fundamentally different from a sudden market shock, wild speculation, or an inflationary adjustment. In Vietnam's clear case, this move appears meticulously calculated. By increasing the dong's value, the government achieves multiple strategic objectives. It can substantially reduce the burden of its dollar-denominated debts, dramatically increase its attractiveness to stronger foreign investment streams, and make a powerful statement of confidence in its long-term economic trajectory. The motivation behind such a move is not about generating short-term speculative profits, but about establishing a position of long-term economic strength and stability on the world stage. Should Iraq choose to follow this precise, controlled model, it could bring about a new era of stability for the dinar, massively enhance the country's purchasing power, and open the floodgates for global investors. This powerful cause and effect relationship is precisely why the Vietnamese event is being universally characterized as a domino moment for everyone closely monitoring currency revaluations worldwide. As the world continues to watch this situation unfold, the official responses from the key players remain notably cautious. Vietnam's central bank has yet to issue a formal, public statement acknowledging the massive change. However, on-the-ground reports and concrete evidence are emerging, with local banking applications and foreign exchange counters already reflecting the dramatically updated rate values. Business owners are sharing authenticated screenshots that confirm significantly higher conversion rates, and international exporters are hastily moving to renegotiate their existing contract prices. While international financial organizations maintain a public silence, insiders anticipate that carefully worded statements will be forthcoming soon. We should watch for specific official language such as currency alignment, monetary modernization, or exchange rate adjustment, which typically serve as confirmation signals without explicitly using the term revaluation. The global markets are currently suspended in a state of high alert, operating in a holding pattern. While most traders are seeking that final, official confirmation, a significant number of investors are already proactively positioning themselves to mitigate or benefit from the expected ripple effects. The immediate and sympathetic adjustment of regional currencies is a strong possibility, and bond markets are already showing signs of response. Major central banks will likely begin rebalancing their foreign reserves, and even the price of global safe haven commodities like gold and silver could see notable changes as capital shifts in response to the perceived changes in global stability. For Vietnam itself, the immediate domestic reaction is a mixture of exhilaration from investors, widespread confusion among the general citizenry, and an official silence from government bodies. Despite the current uncertainty, one inescapable fact remains: the established balance of currency power on the global stage is in the process of shifting, and this shift is occurring with a speed that few analysts had accurately predicted. The deeper implications of this event suggest a new paradigm. If Vietnam's maneuver proves strategically successful, meaning the markets remain stable and investor confidence holds strong, it could inspire a fresh wave of similar revaluations across a multitude of other emerging economies. Nations that have historically suppressed their exchange rates to gain an export advantage may now begin to consider the strategic benefits of strengthening their currency. It is a finely balanced decision. A move that is too swift can severely damage exports, but a move that is too slow risks economic stagnation. Vietnam appears to have successfully navigated this challenge, identifying a calculated middle ground that maximizes stability while capturing economic value. This calculated, sophisticated approach could easily become the new definitive blueprint for currency modernization, not just for 2025, but for the entire decade ahead. It is the quiet financial revolution that very few foresaw coming, but now the entire world is watching its every development. Furthermore, the timing of this entire process strongly suggests a deeper, non-random dynamic at play. Over the past several months, global finance has been undergoing powerful, though subtle, transitions. Central banks worldwide have been intensively preparing for the advent of digital currency systems, updating their interbank transfer networks, and rigorously testing new transaction protocols. The widely reported maintenance windows, observed across numerous nations over this period, could very well represent the systematic technical groundwork required for synchronized global currency updates. If this interpretation holds true, Vietnam's surge may be interpreted as merely the first visible domino in a much larger, pre-planned global financial adjustment. If this hypothesis is correct, then a cascade of subsequent revaluations, potentially including a significant adjustment for the Iraqi Dinar, could materialize in the very near future. The financial community remains internally divided, with some analysts viewing this as a temporary, controlled test run designed to gauge global market reaction. Others firmly maintain that this is the definitive start of a full-scale currency reset where undervalued nations are strategically elevated to their genuine, fair market value. Regardless of the interpretation, the immediate and undeniable impact of the event is clear. The global banking system is aligning, market data is rapidly updating, and massive amounts of investor capital are being decisively shifted toward Asia. The phrase, currency realignment, is quickly replacing revaluation in mainstream financial conversation, but the technical language should not obscure the core reality. Financial power is quietly but decisively moving from the traditional West to the rapidly growing East. As we continue to monitor these developments with intense focus, one critical lesson emerges for everyone: preparation is paramount. Whether you are a professional trader, a large-scale institutional investor, or simply a citizen curious about how global finance shapes daily life, grasping the significance of these shifts early on is absolutely essential. When national currencies undergo a revaluation, the effects extend far beyond the banks and impact everyday life, from the prices paid for imported goods and the cost of fuel to the underlying mechanics of digital transactions. Everything is intrinsically tied back to the exchange rate. What we are witnessing in Vietnam today could be the prologue to an entirely new chapter in global finance, one that places a premium on economic stability, financial transparency, and long-term, sustainable growth. The next critical window for major developments will likely be the next 48 to 72 hours. We must maintain a focused watch on any official statements emanating from Vietnam's central bank, any updates or commentary from the IMF, and any signs of synchronized rate changes in surrounding regional economies. Furthermore, pay close attention to signs of similar monetary policy shifts in Iraq, Indonesia, and Malaysia. Any coordinated adjustments or announcements from these nations will provide strong confirmation that this movement is significantly larger than a one-nation event. We must also continue to monitor global bank downtime, as those scheduled overnight maintenance windows often conceal the most substantial financial updates just before they become public knowledge. The indicators are all clearly visible. It is only a question of when they become official and widely acknowledged. However, alongside the major news comes an elevated risk. Moments of sharp currency movement inevitably attract immense attention, and not all of it is legitimate or positive. We must warn our viewers that this environment is ripe for opportunists, scammers, fake exchange platforms, and self-proclaimed gurus to emerge and attempt to profit from the confusion. Viewers must exercise extreme caution regarding where they source their information. Always verify updates exclusively from trusted, official sources, and never, under any circumstances, share personal or banking details with unofficial, speculative channels. The genuine, profound change we are discussing happens only through transparent and official communication, not via unverified rumors or social media hype. In summary, the stunning overnight surge of the Vietnamese Dong has sent an earthquake through the world's financial markets. It appears to have triggered the first unmistakable wave of what many believe is a comprehensive global currency realignment. Whether this proves to be a one-time, controlled test of the system or the true beginning of a much broader transformation of the world economic order, one conclusion is clear: the underlying structure of global finance is irrevocably shifting. Vietnam's bold strategic maneuver projects a powerful message of confidence, long-term planning, and clear national vision. For nations like Iraq, which have been patiently laying the groundwork for reform, this event may well be the definitive signal they have been waiting for, a clear opportunity to rise, stabilize their currency, and finally reclaim their true economic value on the global stage. The coming days are poised to reveal far more than just new exchange rates. They have the potential to reveal the precise future trajectory of global finance itself. We urge you to keep watching closely as this powerful story unfolds in real time. We on Dinar Shift are committed to being here every single step of the way, delivering only the most recent, verified, and factual updates. This has been Dinar Shift, your primary source for real-time global currency insight. Stay tuned, stay completely informed, and as always, stay ready for what the next moment in this financial evolution will bring.